Okay, everyone, if everyone could grab a seat. Get settled in for this great presentation. Catherine's assured us that she's going to make tax fun. She's a little worried about the, the topic and tax and being a little bit dull, but I think everybody's really eager to hear about it. And Catherine, again, we're really appreciative and excited to hear about this topic. I'd like everyone to put your hands together and welcome Catherine Wilson.
I commend you all for being here for a tax talk. I will try to make it interesting. If you get lost, just put your hand up and I'll go back. But there has been a recent case this year that makes tax interesting, which is, I guess, why I've been invited to talk to you. The first thing I want to tell you is horse racing is farming. You probably already all know that. But that's Section 248 of the Income Tax Act, where maintaining of horses for racing has been included in the definition of farming. So if you're in horse racing, you're a farmer. And that doesn't matter. It doesn't matter if you live in the city and you pay someone to muck your stalls, you're still a farmer. So the first question you have to ask yourself is, are you a hobby or a business? Are you in it for personal pleasure, or are you in it to make money, or at least attempt to make money? If you're in it as a hobby, there are no tax deductions. You don't include the money you make from it in your income for income tax purposes. You're basically fly under the radar of Revenue Canada. You're like a stamp collector or a amateur photographer. It's not a business at all. There's a problem there. If your horse makes money, if you buy a horse and suddenly you're making $100,000 a year in winnings and you're jumping up and down and feeling fantastic, Revenue Canada will find out, and suddenly you're a business, because hobbies don't make money. So then you will have to declare that income, and if you haven't planned for that, it could be costing you more than you want to pay. For instance, if you had planned ahead, you could have been a corporation and you could shelter some of those winnings within the corporation. If you had planned ahead, you would have been deducting your losses in that business over the years. So when you make your winnings, you don't feel so bad giving some of it to the government. So you really do have to think, do I want to run this horse activity as a business or as a hobby? What are my chances of making money? How much money am I going to lose? How do I want to make this look? If you run it as a business, you deduct your tax losses. You deduct your business losses, subject to Section 31 of the Act, which I'll go into in a minute. You declare your income to Revenue Canada. You file as a business in your income tax forms. You are a farm, so you're allowed to report income and expenses on a cash basis accrual method, as opposed to a cash basis accounting method, as opposed to an accrual method. What this means is that income is reported when it's received, expenses are reported when they're paid, rather than when they're incurred. So that can be a very big advantage for you. You can pay for a fence in December and actually build the fence in the spring, and it can be reported in your, your December income tax return. Income includes winnings and revenues from horse sales. Expenses include horse purchases and all reasonable costs incurred to operate the horse business. Horses are inventory, not a capital expense. Now, what's the test to determine whether you are operating a hobby or a business? What does Revenue Canada look at? It's fine for you to call yourself a business, but what does Revenue Canada think? Oops. The first test is a reasonable expectation of profit test. This was the test up until a few years ago. Basically, the Canada Revenue would look at your business, what you've been calling a business in your income tax filings for X number of years, and looking back over a number of years of your filing, they would second guess your decisions and determine whether or not you had a reasonable, being an objective standard, a reasonable expectation of profit. So they would look at the horse that went lame in 2004, which was your best prospect, and they would shake their head and say, that's too bad. They would look at your long years of losses, but for that horse that went lame. And with all the losses, with all the bad luck you had, with the bad business decisions you may or may not have made, looking backwards, looking forwards, those decisions may have looked great, but 3 years later when something happened, they might look bad. Revenue Canada would then wave its wand and say, you know what, you weren't a business, and you will get reassessed and turned into a hobby, which means those tax losses that you claimed in those previous years, they'll make you pay back. So this was the problem with reasonable expectation of profit. Revenue Canada would come in and say, no, you're not a business, because looking back, that happened, that happened, that happened. You had no reasonable expectation of profit. You've been in the business 10 years, you've never made a profit, or you only made a profit 1 year. Doesn't look like you're going to make a profit going forward. You're a hobby. And the money that you were deducting over a number of years, you're going to have to pay back. So this was and is a big problem for our industry. Many of you operate at a loss for years, so it was hard to establish that you're a business. So how do you do that in the face of an industry that often incurs losses? How do you establish that you're a business? Well, you have to look like a business, and you have to act like a business. And how do you do that? You prepare a business plan. You prepare projections on income and expense for at least a year in advance. You maintain proper books and records. You continuously oversee your horse operation and manage your horse operation and make any changes that are necessary to make it profitable. You, in 2003 and 2004, have 15 horses. It's unmanageable. You're losing money. So you make a decision to cut back on the number of horses. That's a decision made with an intention to profit. So you walk like a duck, you talk like a duck. So the Revenue Canada will call you a duck. You've got to make it look like a business. Join your industry groups. Show up at forums like this. Listen and learn. Subscribe to periodicals about the industry and horse journals. Okay, do what you would normally do when you start getting involved in a business, but do it in this business. Fortunately, in 2002, the test for whether or not you are a hobby or a business got a lot easier. And there was a case called Stewart versus the Queen, and the Supreme Court of Canada came down and acknowledged the unfairness of the reasonable expectation of profit test, and they tossed it out because it was vague and arbitrary. You know, Revenue Canada would come in 5 years later and say, we wouldn't have run your business this way, you weren't running it properly, you're gone. And Supreme Court of Canada said that's not fair. Tax collectors ought first to decide whether a taxpayer's activity is undertaken in pursuit of profit or is it a personal or hobby venture. If it is the first, undertaken in pursuit of a profit, it is a business. It is a source of income, period. If it is the second, if there's a personal or hobby element to it, then you look at whether the taxpayer has an intention to profit, meaning whether the business is carried on in a sufficiently commercial manner or in a way that shows business-like behavior. So to put that in simple speak, if there is not a personal element to the activity, it is a business. If there is a personal element to the activity, then you have to look at whether the taxpayer has an intention to profit, whether he's carrying it on like a business. Does it walk, talk, and look like a duck? Okay? So here's an example. You're a stamp collector. Okay? That's something personal to you. You like stamps. So the first thing they would look at with R versus Stewart is say, there's a personal element to this. So therefore, you now have to demonstrate an intention to profit. It's the second kind. Look at harness racing. Most of the time, there is not a personal element to your sport. Okay, you're apart from it. You're not driving. You're not driving a race car. You're not sitting in a yacht drinking a glass of champagne. You've got horses that are sort of apart from you. So certainly in the thoroughbred side, there is no personal element to it, and for the most part in the standard bred side, there is no personal element to it. So you're a business, which is good news. Okay? There is one concern I have. Some of you drive your own horses and are very hands-on and involved. And I wonder if that means there's a personal element to it. I would argue no. You're just saving money, and that's part of the sport. And when you're in a restaurant, you greet the staff, and you might go in the back and help out in the kitchen, and you might be the host. That doesn't give it a personal element. I'm a lawyer, and I'm there physically, typing at my computer, talking to my clients. That doesn't make it a personal element. So I think you're all right. So for the most part, you're a business if you want to be a business. Okay, so Stewart makes it a lot easier for you. The reasonable expectation of profit test is gone. But still, run your affairs like a business. Okay, have a separate bank account and think and read a book on how to start a business and apply that to your standardbred operation. Okay, if you want to claim in your tax returns as a business. All right, next, your business. So, can you deduct all of your losses flowing from this business, like every other industry in Canada? No. If you ran a restaurant, if you opened up, say you're, I don't know, a dentist, and you want a sideline business, you want to do something else, you're now doing dentistry part-time, you've done well, I'm going to open up a restaurant. So that's a secondary business you're opening up, and you have losses in the first 3-4 years because it's a new restaurant. You get to deduct those losses against your primary source of income. You get to take the business losses from the restaurant, $50,000 the first year, maybe $25,000 the second year, and you get to deduct that from your dentist income, $150,000 a year. So in the end, you're just paying taxes on your net income from the two businesses. Make sense? All right? Not with horses. With horses, you are caught by this section of the Income Tax Act, Section 31, which limits the amount you are allowed to deduct against other income. And that limit is $8,750 a year on losses of $15,000. Now, I put it up there not so that you can read it and understand it. I can guarantee it is impossible to understand. Okay, I put it up there just to show you that it is impossible to understand. And the courts have said it is impossible to understand. So don't feel bad. The Supreme Court of Canada couldn't understand this section. Okay, so don't feel bad. But it's there so that you can see it. What Section 31 does is it creates a restriction on the general ability of a farming business, including horse racing, to deduct all losses where the losses are generated by a farming business that does not constitute a taxpayer's chief source of income. This is referred to as a part-time farmer. So if you're the dentist and your dental income is paying for your horse business, you are a part-time farmer, okay, according to Section 31. And what it does is it allows only the first $2,500 of the part-time farm loss plus 1/2 of the loss in excess of $2,500 to a maximum of an additional $6,250 to be deducted against other income. In other words, you get to deduct $8,750 of your first $15,000 of losses. It's a step-up deduction, okay? So you could spend $500,000 on your horse operation one year with losses of $400,000, and you get the pleasure of deducting $8,750 against your other business income. If you had invested that in a restaurant, you would have gotten to deduct the whole thing. If you had invested that in your yachting business, you would have been able to deduct the whole thing. It's only in farming where we have this restriction. And it's been there since the 50s, and it's unfair. Everyone has said so, including the government, and it's still there. Most Canadians take for granted the right to reduce the amount of their income that is subject to taxation from a profitable business or occupation by deducting losses incurred in another business. All businesses are risky. Revenue Canada gets to take your profit from your horse business. Why should they not allow you to deduct your loss, just like in every other business? Well, this is why. It's an historical anachronism, really. In 1952, the right to deduct losses from one business against a taxpayer's chief source of income did not exist. Back in the early 50s, you had one source of income. I don't know, you were in real estate. You were a landlord. So you had your rental income. And any other businesses you had apart from that didn't count. At that time, the Parliament wanted to recognize the benefit that gentleman farmers, or hobby farmers, give to Canada, okay, with respect to arable land, all the good that they were doing. So they had an unofficial policy of allowing 50% of losses incurred in part-time farming activities to be deducted against the taxpayer's chief source of income. So farmers were the only people that could take their losses and deduct a sizable portion, 50% of it, against their primary income. And that was because it's beneficial to the agricultural industry. In 1951, they formalized that in legislation, and they gave farmers a $5,000 deduction. So you could take your secondary business of farming, because you're a part-time farmer or a gentleman farmer, take $5,000 of that, the losses, which in 1951 was a lot of money, and apply it against, to reduce your primary income on your tax returns. Okay? Great advantage. In 1952, they said, we're going to do this for everybody. So suddenly, all secondary businesses that suffered losses, you could take those losses and apply them against the income from your primary business, just like today. So now if you run 2 or 3 businesses, some make money, some don't, you kind of put them all together, and there's your net income, which you're taxed on. That's the basis of our tax system today. But they didn't get rid of this limit for some reason back then. The 5,000 stayed. And not only that, they put in to farmer the maintaining of horses for racing back then. And since that day, we've been stuck with it. So suddenly we went from a position where we were getting a more lenient and advantageous treatment to a position where we have been disadvantaged, where we have this incredible restriction on the ability to deduct our losses. And it's been there for 50 years, and in 50 years, the restrictive amount has gone from $5,000 to $8,750. It hasn't even kept up with inflation. It should be up at about $50,000 now, if we were even keeping up with inflation. So, looking at the section itself, it's contradictory and unclear. So let's have a look at it and see what it says. The underlined part is the part that's the worst part. Where a taxpayer's chief source of income, and I'm going to skip some of that gobbledygook, is neither farming nor a combination of farming and some other source of income. Okay, that's the problem right there. If you're a farmer and you're in the business of farming, your income is either farming or farming with some other source of income, if you're farming. So it would mean that everybody is excluded from this section. It didn't make sense. This was a big problem for the courts and for everybody trying to deal with this section. So in the 70s, the Supreme Court of Canada came out and tried to fix this. What does this section mean? Who is caught by Section 31, really? And they came out with a case called Muldown versus the Queen. And Muldown versus the Queen had 3 types of farmers: full-time farmers, part-time farmers, and hobby farmers. It sort of divided from Section 31 farmers into 3 sources. And what they said, what the court said, was we're going to take a word, subordinate, and we're going to put it into that underlined phrase. So what they did is they said, where a taxpayer's chief source of income for a taxation year is neither farming nor a combination of farming and some other subordinate source of income, the horse business would be caught by the restrictions in Section 31. Would be caught. So basically what they mean is, if farming is your primary source of income, you get to deduct all your losses. If farming is a subordinate source of income to your other incomes, if you make less at farming than you do at your dental practice, Section 31 applies to you. That's how they tried to make sense of the section. This has created its own problems. Where a taxpayer has farming income and another source of income, if the horse business does not generate more income than the other business, or at least a similar amount of income, it is automatically caught in Section 31. What this has meant is in the 70s, for instance, farms in Saskatchewan, they had a drought, they had bad times. So you're a farmer for 10, 15, 20 years, 25 years, you have to save the farm. So for 5 years you go out and you drive a school bus. And the income from your school bus is supporting your farm for those 5 years. Before that, you made a profit, but there's been a drought, so you're driving a school bus for 5 years and you're supporting your farm. Revenue Canada, at the end of those 5 years, would come in and say, your farming income is less than your income from driving a bus. You're caught by Section 31. And they would restrict that farmer's losses to $8,750. So for 15 years of farming, that farmer would have been dutifully paying on his income made from the farm. In those 5 years, suddenly he's got losses, $20,000, $40,000, $50,000. He's driving a school bus to keep the family farm. Revenue Canada comes in 5 years later and says, no, 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 you can't deduct your 20, your 40, or 50. You're limited to $87.50. Pay me back the money pay us the money you owe us. And these farms are going out of business. And that happens all the time. That's happening today. That's happening to horse businesses too. You can consider yourself to be a full-time farm. Suddenly you run on hard times and your income in your horse business is less than your income from something else. And then spoop, you're a part-time farmer. And all those losses that you were deducting, you got to pay us back. Are you with me so far? Okay, good, because this does get complicated. So, what have we tried to do about that? The Department of Finance has attempted to justify this restriction on part-time farmers in the following way. They say that hobby farmers take undue advantage of tax benefits, such as cash basis accounting. Well, the rules on cash basis accounting changed in 1989, and those benefits are largely erased. So that's point one. They say full-time farmers would find the price of farmland increasing unduly if hobby farmers were given a more generous tax treatment. Well, the real threat to farmland now is development, not part-time farmers, so that argument's out the window. And they say that the provisions allow the use of a generous interpretation as to whether a farming activity has a reasonable expectation of profit. Well, that test is not being used anymore, so that's not an argument either. What Section 31 does is it places an unfair tax burden on us and it hobbles our industry. Because how can you convince somebody to invest in standardbred racing when their tax losses are limited to $8,750? They could invest in anything else and they can deduct their losses fully. How do you make that pitch? It's very difficult to do. The Horse Racing Alliance of Canada, Horse Racing Tax Alliance of Canada, is an organization representing over 40,000 owners and breeders of racehorses and 70 racing organizations across Canada. And it's been trying for years to repeal Section 31. And it has succeeded a couple of times in getting the Standing Committee on Finance to agree and say Section 31 has to be repealed. We were this close, we thought, to getting the thing repealed. But in all that time, and with lots of money and lots of effort, the feds won't do it. They won't even raise the rate. So we're stuck. Now, why I'm here today. There are some positive developments in this, and it's in the cases. It's the courts that are helping us because the government is not helping us. So first, let's go through Muldown and the full-time farm, the part-time farm, and the hobby farm, because this is where we were up until basically January of this year, okay? So if you were a full-time farmer, those for whom farming may reasonably be expected to provide the bulk of income, meaning your majority of income is from farming, or the center of the work routine, you could deduct your losses without a problem. All your losses, there you go, okay? And some of us fit into that, and that's great. Part-time farmers, that's most of us. Those who carry on farming as a business, but for whom farming or farming and some, there's that word, subordinate source of income does not constitute his or her livelihood, but rather a sideline business. Those are the part-time farmers, and they fit into Section 31 and have their tax losses restricted. And then there's the hobby farmer, those who aren't running a business at all, okay, and they don't get any deduction of losses at all. That's where we were until Gunn came along. Gunn is the first case in 2006, Federal Court of Appeal, that rejects that test in Muldown and says, you know what, that inserting of the word subordinate doesn't make sense, because it means basically that any part-time farmer with, who hasn't got the bulk of the income coming from farming will always be caught. It just doesn't make sense. And they changed the test. And what they said, and you'll see there on the second bullet, I'm going to read it, and then I'm going to explain it. The combination question should be interpreted to require only an examination of the cumulative effect of the aggregate of the capital invested in farming and a second source of income, the aggregate of the income derived from farming and a second source of income, and the aggregate of the time spent on farming and on the second source of income, considered in light of the taxpayer's ordinary mode of living, farming history, and future intentions and expectations. In short, what they're basically saying is, we're going to not just look at the money made, we're going to look at your time spent in farming and your time spent on your dental practice or on your car dealership or on something like that. We're going to look at the capital you've committed to your horse business and the capital committed to your other business. We're going to look at how you run your life. What do you do every day in your business, and what do you do every day in your horse business? We're going to consider it all together, and then from that we're going to decide whether or not you're a full-time farmer or a part-time farmer. It's not important whether or not most of your income comes from farming. That's only one aspect of this test. Okay? And it's a big thing, because now suddenly you don't have that hurdle. And it means that a lot of part-time farmers today can become full-time farmers with full loss deductions. That's really important. Now, in Gunn, Mr. Gunn was a lawyer, and he ran a cattle and crop farm in addition to his law practice. He had losses in all but 2 of 18 years in which he ran the farm. And in some years, those losses were as high as $100,000. He made good money at his legal practice, and that funded the farm. Revenue Canada wanted to call him a part-time farm, and he wanted to be a full-time farm, and he won. And this is why, because they expanded the test. If they had used the Muldown test, he would have lost, because clearly he made losses all the time. Another point that Gunn made, which I like, is that Section 31 used to be applied more tightly to horses, okay? Revenue Canada doesn't like horse people, all right? We're rich and we're fabulously wealthy and we're wasting our money on the sport of kings, where it's not really a business anyway, okay? They don't understand that most of us are, regular folk who kind of put money together and do it, or we put together syndications and stuff like that. They don't get that. We're all E.P. Taylors, according to Revenue Canada and the Ministry of Finance. So they look at our business as being light. It's not like being a hog farmer or another legitimate farmer. That's what they call those other farmers. They're legitimate farmers. You're not. Okay? And Gunn says, no. All right? You're a farmer. You're a farmer. And you're on the same test. Doesn't matter if you're a city slicker, dentist in the middle of the city, and you're paying someone else to look after your horse. It doesn't matter if you're out there shoveling manure. You're all treated the same. It's the same test. And I think that's really important for our industry. All right, and then came along Craig. R versus Craig is a 2011 Federal Court of Appeal decision. The tax court decision was obviously earlier than that. The tax court decision is brilliant, and that's the decision you should take to your accountants, together with the Federal Court of Appeal decision, which says, yes, we agree, basically. But the tax court decision is the one you want to read, because it will apply to your business. And basically, it said that the legal case of Gunn was good law and expanded the test in Muldown. Now, here are the facts in Craig. And this is important, because I want you to listen to these facts and think about your own business. And if the facts are similar to your business in any way, I want you to go to your accountant and talk about whether or not you should be a full-time farm this year as opposed to a part-time farm, okay? Because you might be able to apply as a full-time farm. These cases are fact-specific, okay? The law doesn't change except for these big cases, but the law doesn't change very much. It's applying the law to your business, all right? So you can be a dentist, a salesman, own a car dealership, but if you're in a similar situation as this lawyer, then consider it. So Mr. Craig was a lawyer from Toronto, and he practiced for about 35 years, and he did very well. He spent about 1,500 hours a year at his legal business. He also was active on several boards of directors, and he earned income from that. He also made significant investment income in the oil and gas industry. That's where his legal expertise was, and he made some money in that industry. So he had significant income from a few sources unrelated to horses. But Mr. Craig was also passionate about horses. He was actively involved in the standardbred horse ownership and racing for 25 years. And they determined in the court, Tax Court of Canada decision, that he spent about 600 hours annually in horse ownership and horse-related activities. So about 1,500 hours in his legal business, then he had the boards and, that kind of thing. And then he had his horses, 600 hours in his horses a year. What did he do? Probably the same things you do. He would review every morning internet racing services. He'd have daily telephone calls with his trainer. He'd, on Saturday mornings, go out to the track, talk to his trainer, the vets, watch the training. He'd attend racetracks, attend the races in excess of 40 times a year. He reviewed horse sales catalogs. He attended sales, maybe 3 or 4 a year. He worked with the standardbred industry on a couple of boards, such as the Standardbred Appeal Board. So they had meetings, 3 or 4 times a year. He would attend conferences like you're doing today. And he would maintain business records, okay? He didn't do financial statements, all right? Sole proprietors, people who run a business on their own, don't have to do financial statements. You only do them if you're applying for a loan for a bank or something like that. So he didn't do financial statements, but you don't have to. But he did maintain records. So I would assume that these activities are not uncommon to all of you, okay? Now his income from his law practice and his boards and his investments was far, far in excess of his income from his horse business. In fact, in the 25 years of racing, he had only had 6 years of profits, okay? And these profits were minimal. They were inconsequential to the losses that he had suffered over those years. In the years under appeal, which were years 2000 and 2001, he suffered a total of $400,000 in losses in those 2 years. So this was big, because if Revenue Canada was right, $8,750 times 2. Thank you very much. Those are your losses. That's what you get to deduct. If Revenue Canada was wrong, $400,000 in losses. Okay, so this was big. Mr. Craig had always employed a trainer. The trainer looked after the horses, including the provision of all facilities, feed, and hands needed to maintain and train the horses. Mr. Craig had no farm. He was not involved in the horses' care except, to give direction and write the checks. He was a lawyer from Toronto with a passion for standardbreds, right? He's a city slicker. He didn't muck stalls. He paid someone else to do it. So he's like your worst kind of horse racing enthusiast, according to Revenue Canada, right? He's the E.P. Taylors of the world, according to Revenue Canada. He had no written business plan to demonstrate that his horse racing operation can or could have a reasonable chance of consistently earning profits, be a chief source of income, or being the means by which he could earn his livelihood. For the foreseeable future, his law practice and his other endeavors would earn his keep. He had invested a lot of capital in his horse business, chiefly in horses, so he spent a lot of money on it and didn't get much out. This is what the court found. The court decided Mr. Craig was a full-time farmer. In other words, Section 31 didn't apply to him. They said they followed Gunn. Revenue Canada, or the Crown in this case, tried to say Gunn is bad law. Gunn is distinguishable. Gunn doesn't follow the Supreme Court of Canada. You've got to have the bulk of your income coming from the horse business, or you're under Section 31. And the court said no. Farming or the racing business no longer needs to generate the highest income of the taxpayer's businesses in order to avoid Section 31. In other words, to avoid Section 31, a taxpayer's chief source of income does not need to be farming and some other subordinate source of business. A farming operation can be a full-time farm even if it may never be a chief source of income. That's big. And what test did they use? The same test you'll see on the screen as in gun. And I'm not going to say it again because I have to say it about 3 times to myself before I understand it, but it's written up there, and it's written in the case, which you can Google. You can go onto the internet and you can Google Craig versus R, tax court, and it'll come up. But I'll simple speak it on the next slide. So here's the test in simple speak. The court will look at time spent at the horse operation versus time spent at his other businesses. The court will look at the capital committed to the horse operation. And that's buying horses, that's, you know, I don't know if you have a farm, building fences, building a track, all of that type of stuff. The court will look at the potential for profitability. Now, your horse business can't be, you know, la la land. It's still got to walk, talk, and look like a duck. So you've got to have some meaningful expectation of profit. Okay, some intention to profit. You can't just be throwing money at something and saying, oh, it doesn't matter if I ever make any money, because that's not a business. So the court is going to look for some potential profitability. But the good news is it doesn't have to be profitable today. And look at Craig. You know, 6 years of profits and 25 years of incredible losses. And look at Gunn. You know, in I think it was 20 years, he had 18 years, he had 18 years of losses, he had 2 years of profits, I think it was. So you can have a long, long stretch of losses. If you have a few profitable years, that's okay, as long as they look at your business now and say, you know what, there's a good potential or probable potential, you'll be profitable again in the future. You're trying. You're trying. They'll look at the taxpayer's ordinary mode and habit of work. That's why they got into the details. Every morning, you know, he went to the racing screens and he talked to his trainer. What did he do on Saturdays? You know, how many races did he attend? What did he watch? You know, races on TV at night. It's very important how you conduct this business, how much time you spend on this business versus how much time you spend on your other business. Okay? And these factors, these 4 factors, time spent, capital committed, potential profitability, and your habits, your ordinary mode and habit of work, these will be looked at cumulatively to determine whether farming is more than a sideline business. If it's more than a sideline business, you're a full-time farmer. Section 31 will not apply to you. And in this combination test, farming does not need to provide the bulk of the taxpayer's income or even ever be the predominant business or work activity of the taxpayer, which is great news. Gunn has provided a more generous test, and it expands the group of farmers that can avoid Section 31. Okay, there were some other points of interest in this case. Number 1 is that the risky nature of horse racing is irrelevant to the application of Section 31. This court says all farms are risky, and the horse business shouldn't be given a rougher ride in this regard. Okay, all farms are risky, so just because it's a horse business, you don't get a higher standard. And unfortunately, earlier cases had done that. The use of a trainer and other farm managers is irrelevant to the application of Section 31. This is that city slicker farmer distinction. Craig confirms what Gunn said, which it doesn't matter if you muck the stalls yourself or pay someone else to do it. Doesn't matter, it's irrelevant to Section 31. And the other thing they said is that horse racing should not be viewed as a recreational diversion, more consistent with a sideline business than with an objective expectation of earning a profit. This is a cynical bias that has no place in the application of Section 31. So that's good too. They're giving our industry the legitimacy that it deserves. Okay? What does this mean? What now? Well, if you have been claiming as a part-time farmer, ask your accountant or lawyer to review the Gunn decision, to review the Craig decision, and determine whether you should now apply as a full-time farm. Okay? Figure out how many hours you work at the one business. If all you do is horses, you're a full-time farm. If that's how you make your income, no questions, you're a full-time farm. But I'm speaking to the people that do horses and have income from other sources. And maybe the income from other sources supports the horse operation. You people should be going to your accountants and saying, I spend X hours a year on my horse business and I spend Y hours on my other businesses, and this is what I do in my horse business with my time, and this is the capital I commit each year, and this is how I run my life around these horses and work in my other business. And look at Craig, and am I on four feet, or am I on all fours with Craig? Because if I am, then I should be able to be a full-time farmer. What do you think? And see what your accountant says, see what your lawyer says. Okay? A second thing you could do, contact your MP. We believe, will be an election year. This is a good year to get in touch with your MP and say, hey, Section 31, the Horse Racing Alliance of Canada, all of our industries have been after you for years to get rid of that section. Farmers have been after you for years to get rid of that section. Get rid of it, will ya? Or I'm not voting for you. All right? And there may be something coming out through these associations, through our associations in the future, this year, I'm hoping, to give you assistance with that. But contact your MPs and say, we don't want Section 31. And if you're going to force us to keep it, it's unfair, it's draconian, it's the only restriction on losses in the entire Income Tax Act on any industry, then at the very least, raise the limit, $87.50. What's that? That's a snow cone these days, right? Let's raise it to $50,000. Let's raise it to inflation, at least. Okay? And finally, contact the Horse Racing Tax Alliance and ask what you can do to help, because we've got to move this forward. That's basically what I have to say. I hope I didn't lose you along the way. If you have questions, let me know.
Quantum, in terms of the expectations of the court's place, in other words, time committed, capital committed, is there a threshold that the courts will say if it's not below this level, then yes, you're a farmer?
It will depend on the cases. So you have to look at Gunn and study what he did and how he did it. Now, he was a hands-on farmer, okay, in some respects, more so. And Craig was absolutely, a lawyer in a high tower, paying other people to do it. So look at Craig, look at Gunn, and look at the time they spent. I will tell you, the Federal Court of Appeal, when it upheld Craig, there was an obiter comment, meaning kind of a sideline comment, from the judge writing the opinion saying, if I was the trial judge, I may not have decided the same way. This is kind of close to the line, but I'm not going to interfere with the trial judge's discretion. So he sort of made noises to the effect that Craig was cutting it pretty close to the line between full-time and part-time. But it's there, it's good law, and if you come on all fours with Craig or better, you should be a full-time farmer. And it'll be case-by-case specific. 3 years from now, we'll have 2 or 3 more cases, and then I can tell you with more detail what works and what doesn't work. Or else it'll get all screwed up and become very complicated, and I won't be able to tell you anything. Or we'll get the legislation changed, and we'll be fine. Because the biggest issue for industry right now is the indecision, the confusion surrounding this distinction. Yes?
Is it retroactive?
Is what retroactive?
If we claim years of no losses as, because we consider ourselves a hobby farmer, can we go back and claim losses from previous years?
Yes, not all the way back, but you can go back a certain amount, yes. Anyone else?
Anybody
Oh,
asking,
please.
if you could use the mics just so everybody can hear, because it's tough, I think, across the room to hear what the questions were. But
Yes?
You used the example of the dentist or a caregiver. Where does a retired person fit in?
All right, so where does a retired person fit in? Well, again, it's just simply, what are your income sources? So as a retired person, one income source is your pension. One income source are your investments. So what's bigger, your income from your farm or your income from your retirement sources? So they would just look at that. An investment income counts just like employment income, just like pension income. Okay?
Catherine, I have a couple questions. related more to our region and the industry here, with the purse structure not as lucrative as other places. The expectation of profit, I guess, lies more on either yearlings or young horses in stake races, or exporting and selling down the road. For the regular overnight horse, it's pretty tough to kind of do a business plan that's going to show a lot of profit unless you're really doing it yourself and running that type of business. But you know, is that something that would be unique to this area, or do you find it?
Well, 2 points. First of all, profit isn't that important. Look at Craig. If you actually pull the tax court decision, it lists profit and losses over the years, and it'll blow your mind how much the amount of losses were, okay, for his business. So profit is not that important, okay? If your losses are, you know, $15,000 to $20,000 a year because you're running a smaller operation and you've made a profit of $5,000, that's a lot better than Craig did, to be honest with you, okay? So profit is not that important. And secondly, you guys can't make a profit. It's so hard because you're like this, you're tied, because you can't deduct your losses. How do you run a profitable business when your income is completely taxable and your losses are limited to $87.50? So the industry itself has been like this for 20 years, you know, for 50 years. So the idea is to loosen these hobbles or get rid of them and let you guys start being able to crawl and then walk and then run. And I guarantee you, in a number of years, you're going to run a business like every other business in Canada, a profitable business. But you can't do that when your losses are limited to $87.50. You can't get the people in to invest, which makes it a healthy industry, and you don't want to invest the money yourselves, which makes it a healthy industry, because you're restricted if you lose. So if you get rid of that and you're allowed to run it like a restaurant or any other, then you will be profitable, because you're all innovative people. You're doing incredibly well in spite of this restriction. You're still here. So you know, the sky's the limit if we can get this off. And RevCan will be happy. They'll be getting more money from you guys. You'll be happy. You'll have thriving businesses. There'll be investment in the industry. It's a win-win for everyone, and that's what we have to tell the feds. Okay.
So with new owners, I guess, approaching new owners and taking this forward, it would be fair to say that there is, with your investment, it is a business, as long as they treat it like a business, and they can invest into, say, a young horse that's going to be potentially $20,000 before it ever gets to the races, if it gets there. That $20,000 would be reasonably ruled against their current income.
I would say, yeah, get yourself an accountant or lawyer that knows about this stuff, and consider seriously filing as a full-time farmer, looking at these cases if you can fit within these fact situations, because it's a much larger class now. Okay, the old rules don't govern anymore. It's a much bigger group, and you may be able to be part of that group. And as a new owner, you can pattern your business that way. And also just agitate with your MPs, and let's get some fairness into this system. Okay? Thank you.
Any other questions for Catherine?
Oh, yes?
Ron, could you just use the mic there, please? Thanks.
My wife and I are considering getting involved in the horse business. To claim what is happening now with the changes to the tax rules, would we have to be an incorporated company and to be a full-time farmer? Would we have to be incorporated to do this and to claim?
Good question. No. You can be a sole proprietor, you can be a partnership, you can be a corporation. Most people in this industry are either sole proprietors or they're partners. And by partnership, I'm including syndications, co-ownerships. Basically, there's a flow through of income and loss to the individual people. The only time incorporation really helps you in this industry is if you're making tons of money and you need to shelter it in a company. So that's usually later on in your business, or if you have a farm and a breeding thing and there's some liability issues. But for most of you, you're going to be either a sole proprietorship or a partnership, and that's fine.
And in order to take advantage of this, so you get a business number, right?
Yep.
A
Get
sole
a,
proprietor
yeah,
business
get a BIN number, walk like a duck.
Right? As far as HST goes, it's, I think the threshold is 36,000. If you make more than 36, you have to charge and claim HST, but under, it's up to you, right? So
Yeah, yeah.
that's two things. And then for the Section 31 as it stands today, listening to everything through, is there anyone in the business, with the exception of just the hobby guy that accepts it as a hobby, that wouldn't even at least qualify for that? Like that?
Once you're a business,
section.
you are able to deduct your losses,
Full losses.
period. And the only issue then becomes, can you deduct more than $8,750? And that's whether or not you're caught by Section 31. Once you're a business, deduction of losses is automatic in Canada. Okay,
Anyone else?
thank you. You didn't fall asleep. Good on you. Oh, can I just, two more things just quickly, some show and tell. The Horse Racing Alliance of Canada has this small book, and there's a much larger book called The Proposal for the Fair Income Taxation of Horse Racing. This is in detail our complaints, the history, and what we're trying to do about it. So that's some fun reading for you. And just, can I tell them about this? Yeah, absolutely. Thoroughbred ownership? The Ontario Jockey Club has put out a book called A Guide to Thoroughbred Ownership in Canada, and it has useful discussions in here on whether you incorporate, whether you do syndications, the tax stuff. So you could contact the Ontario Jockey Club, and this would still be useful for people who want to get into standardbred racing. It just kind of tells you about the rate. There's a lot of stuff that applies generally to the racing industry in this book.
Thank you very, very, very much, Catherine. I've got somewhat of an accounting background, so that was exciting for me. I really, I don't know about everybody else, but I think that's some information there that really opened my eyes, opened a lot of eyes. You know, in my mind, that really changes going forward how we approach owners, how we approach new people coming in the business, and it is a business. You know, we've been treated unfairly for many years, and it's great to see us moving forward.